Hi, David Hillier here, and today I'm going to be giving you the final video on my series looking at efficient markets and behavioural finance. And in today's video, I'll be looking at, what impact does efficient markets and behavioural finance have on you as a manager of a corporation? The material that I've covered so far has really focused on the stock markets. And with the stock markets, you're really in the investor world. So today it's bringing it all back into the corporate finance world and looking at some areas where managers make decisions and asking the question, well, if you believe that the market is inefficient, can you take advantage of that? And if you can take advantage of it, then what impact will that have on your organisation? So let's go on, and we're going to look at four main areas today, and those four areas link to how you use the accounting statements, how do you decide on when to issue new equity, decisions relating to buying over other companies, and the final thing is managers using prices for their own decisions. And that's quite an interesting one, which I will come back to at the end. So let's start off with the accounting choices. We have nearly 100 accounting standards. Those accounting standards relate to things like how you present your accounting statements. They talk about leasing. They talk about use of derivatives. A whole range of different standards relating to how you present your information in the company accounts. Now, as an investor, you won't have a lot of time to read through all those accounting statements and go in and understand them and understand the details or the impact of the accounting statements or the accounting standards. What impact does the accounting standards have on your accounting statements? And since you don't know about the most up-to-date changes in accounting standards, you don't then know how that may affect the reporting in the accounting statements. Because just as an investor, you don't have all your time to spend just going through all the detail. Similarly, if you look at an annual report for a company, you will find that you read through the bit at the beginning that's just telling you what the company has done, its overall performance during the year, and that's written in a way which is very reader friendly. You then go on to the reports, which is the balance sheet, the income statement, the cash flow statement, and then after that you have notes to the accounts, and that's where all the details are. But as an investor, you might not have the time or the knowledge to go into those notes and understand them fully. So you could argue that given that that's the case, that managers could potentially interpret the accounting standards in such a way as to make their sets of accounts look much better. And if that is the case as a manager, then you may be able to take advantage of investors not having a full set of time or information to interpret what you're doing. Now, the research shows that on average, now it's not for every standard, and because every standard changes, that what I'm about to say might not apply, and it might also not apply in different countries. Most of this research has been carried out in the US, less so in Europe, but outside of that, there's very little high quality research that looks at this. But from the high quality research, the research that's published in the top journals, the overall evidence is that the markets can't really be misled by changing the accounting figures. And so as a result, you can't actually take advantage of working with the flexibility in the accounting standards. So that's not very great for the behavioural finance side, and it's actually quite supportive of efficient markets. But I have to just make one bit of emphasis here and say that fraud is different. Fraud is where you use the accounting standards but you actually put in the wrong information. You do actively mislead investors. And there, because investors are misled, the prices can change. But always what happens is when the fraud is detected, there is a massive impact on the share price. And not only just because the company has lost confidence by the investors, but also because there's going to be a big, massive regulatory fine coming down the line, and that has a big impact on the cash flows and the value of the company. So accounting standards, you can't really take advantage of them in the biggest markets, but potentially they may be able to do that, and research would have to be carried out to look at each standard in each market. Let's look at the next thing, which is about timing. So can you as a manager time the market? Can you look at share prices and make corporate decisions given that you believe that the market might be overvalued or undervalued? And here what I'm doing is I'm looking at seasoned equity offerings. And in seasoned equity offerings, you'd almost always tend to find that managers have a seasoned equity offering after the share price has gone up, and you can see that round about here. This is the issue day. So the companies have equity offerings when the price is at the very highest, so they're selling their shares at the very highest price. But that doesn't give any insight into whether the market is efficient. Why? Because what happens after the issue that tells you if it's efficient or not. So if the prices reach a certain level and the prices stay the same, then you would say the market's efficient. You might even say, well, okay, if the share price is going up and the managers have an issue and the share price continues to go up, that tells you that the managers could have sold the shares at a much higher price. And that would tell you that managers aren't actually able to time the market. They're not able to take advantage or identify when the share price tends to be higher than maybe it should be. But if the price drops after the equity issue, then that's telling you that the company has issued those shares at the very right time and the share price has dropped. And there is some evidence, and it's evidence that I've seen, that managers are actually able to do that. They do time their equity issues so that they're taking advantage of market movements. That's the case for seasoned equity offerings. However, it doesn't seem to be the case, or the results aren't as strong for initial public offerings. That is when the company goes to the market for the first time. You don't get that same strength of result there. So quite an interesting thing, that maybe if managers are running a public company, they do know a bit more about their share price than other investors, and they can take advantage of that. So that's quite an interesting insight into the advantages that companies have with respect to their own share price. Let's look at this next case. Now, this is an example that I've taken from a book. It's a chapter 28, so it's in my mergers and acquisitions chapter. And you're looking at the share price of Shire, which was being taken over by another company called AbbVie. And what it's saying is that when you do get lots of acquisitions in the markets, and if you get lots of acquisitions, companies that are acquiring other companies, they have to bid over the price to encourage the existing shareholders to sell their shares. And that premium that they pay should reflect the increase in the value that they're going to get from taking over this company. Because why would you ever take over a company? You're taking over that company to create more value, to create synergies potentially, or to improve the performance of a management group. And I'm just using an example here, but this is fairly representative of what the research shows, is that when you put in a bid, actually you go through a process for that bid, and by the time that a share or an acquisition is actually made, the share price is actually much higher. That you've had to put in a number of bids to incentivize existing shareholders of the target company to sell. And the research shows that, well, once you bring that bid premium into play, that these mergers or acquisitions don't tend to create a lot of value. They don't release value. And that means that, is there really any great impact or great thing about undertaking an acquisition? And that's just the overall research. I'll go into this in a lot more detail in later videos when I cover mergers and acquisitions. And we're now going to talk about the last case, and that's information and prices. So if the markets were efficient, they would give information to managers, because they can actually tell managers and investors whether a company is performing well or whether it's not performing well. And if that's the case, then you will see company decisions responding to share prices. And let's look at this case. This is where you get, you're looking at cumulative returns, and it's actually abnormal returns. We call them mean prediction errors here, but they're abnormal returns. I spoke about that earlier on in a video in this series. And you're seeing that these are companies that have been performing worse than you would expect consistently over a 36-month period. And what we're doing there is we're looking at a sample of 43 forced departures of managers, of leaders of a company. And you're then saying, well, okay, if we set time 0 to be the month when they departed, they were forced to depart, what were the share prices like, or what was the share price performance like before and after? And you can see here that for this sample, that those companies that forced their managers out, they actually performed a lot worse in the previous 3 years, which suggests that investors do take into account prices, which would tell you then that prices are efficient. And there's some research that I carried out that looked at how managers react when they make an announcement of an equity issue linked to a big project. So they're raising money for a big project and the share prices drop as a result. Now, if the managers knew more than the market, then they would still go ahead with the project. But we actually found that managers changed their use of the funds, or didn't even sometimes go forward with the issue because the announcement was so negative, which tells you that the managers are taking market information into account when they make decisions, which tells you that managers think that maybe on average that the markets are efficient. So to finish off then, a lot of this research that we've looked at is based in developed countries, and it may be that you might not be running a company in a big massive economy, and so there may be some opportunities for you to take advantage of inefficiencies in the market. And also the evidence on behavioural finance and market sentiment, and for certain periods the markets may not be particularly rational, really gives you a bit of an impetus as a manager to say, right, okay, well, you should always be on the lookout for how markets are moving about. And I'll give you just one very topical example, which is to do with the currencies, so sterling. And we're in a period just now, so this is the 12th of October, 14th of October, 2016, when sterling has plummeted massively, and all of the newspapers are coming out saying this is a disaster, this is terrible, that, and we're seeing it everywhere. And behavioural finance researchers always say one thing: when the newspapers are being really, really negative about something, and everyone is being negative, that's when you buy, because lots of uninformed investors are jumping in and they are acting on what they're reading in newspapers without doing a real full analysis. And similarly, when everyone is telling you how great an asset class is, or how great a company is, and really making the investment class, the asset class, as if it's fantastic, that might be the time when you jump out. And you see that type of cyclicity in stock markets, you see that type of cyclicity in property markets, and it is quite an interesting thing. So if you're running a company look at that as well. Look to see if, and just watch it over time and find out, well, do we see some market sentiment movements that you can potentially exploit? So many thanks for listening. This is the end of our Efficient Markets and Behavioural Finance video series, and in a few weeks' time I will come back with a new set of classes relating to a different part of corporate finance. So thank you very much.